Welcome to the Deep Dive. We break down the earnings calls so you don't have to.
Taking that fire hose of information and finding the nuggets that matter.
Exactly. And today, we're tackling Educational Development Corp. That's ticker EDUC. Their fiscal 2026 second quarter results.
Right, and these results, they came out after the bell on October 9th.
And the reaction was pretty swift, wasn't it?
Oh yeah, immediate, sharp. The stock dropped almost 10% right away. Management was trying to paint a picture of, turnaround efforts.
But the market wasn't buying it.
It seems like the operational news, the really tough stuff, just completely overwhelmed any positive spin on cost control. Anxiety was palpable.
Okay, so let's get into those numbers because looking at the headlines, it's a bit confusing. Mixed signals, maybe?
Mixed is a good way to put it. So net revenue, $4.62 million.
Which sounds low.
It is. That's down 29% year over year, a huge drop.
29%, wow.
But here's the mixed part. Their loss actually narrowed. GAAP loss per share was negative $0.15.
Okay, and last year?
Last year was worse, negative $1.22 per share. So an improvement on the bottom line.
And the net loss figure itself?
Also better, down to about $1.29 million loss from $1.80 million loss in the same quarter last year. So you see the cost controls are working. Somewhat.
Right. So if you only looked at the loss narrowing, you might think, okay, they're stabilizing.
You might.
But obviously the market didn't see it that way. There must be something else. What was the number that really spooked investors that triggered that nearly 10% dive?
Yeah, that would be the core operational metric, the lifeblood of their direct sales model.
The brand partners? PaperPie partners?
Exactly. The average number of active PaperPie brand partners for the quarter, just 5,800.
5,800. And how does that compare?
That's the staggering part. It's down 58% from the previous year.
58%?
58, almost 2/3 of their active sales force, gone in a year.
Okay, that explains the market reaction. That's not just a headwind. That's, like you said, the engine seizing up.
Precisely. When you lose that many partners, you lose your reach, your momentum, everything in that direct sales channel.
So how does management even begin to address that kind of collapse?
Well, that's the core tension here. They focused heavily on the financial side, the balance sheet stabilization.
Which we need to get into. The debt situation sounded pretty dire.
It was, and arguably still is, until the fix is complete. Their bank loan agreements expired back on September 19th.
And the bank responded.
They did. The company confirmed they received a formal notice of default and reservation of rights.
Okay, translate that. What does reservation of rights actually mean in practice?
It means the bank is putting them on notice legally. It gives the bank the right to, demand immediate repayment of everything.
Everything.
Everything. Liquidate collateralized assets, think accounts receivable, inventory, equipment, the works. And slap on an extra 2% default interest rate. It's serious leverage.
Basically, the bank can pull the plug.
Legally, yes.
Yeah.
Now, management's take was different.
How so?
They framed it more as a procedural step, a formality the bank uses mainly to light a fire under them, to get one specific thing done.
Which is the big fix.
The sale of their huge Tulsa property, the Hilti Complex.
Right, the linchpin of this whole thing. What's the status there?
They expect it to close by mid-November. The target date they mentioned is before November 25th. They need this.
And the price tag?
$32.2 million is the target.
And that money goes straight to the bank.
Every penny, basically. The plan's very clear. Use those proceeds to retire all outstanding bank debt. Wipe the slate clean.
Which would obviously remove the default risk and that huge interest cost burden.
Exactly. It fundamentally changes the immediate financial picture. They also mentioned the buyer is apparently a sophisticated real estate player related to Tenmark Holdings.
Trying to boost confidence that the deal will actually close.
That seemed to be the implication. Management expressed, and I'm quoting here, a very high degree of confidence it gets done.
A very high degree, okay. So if, and it's still an if until the check clears, but if the sale closes and the debt's gone, what happens next financially? Do they need new funding?
Yeah, they'll need operating capital. But they're planning to be much more conservative. They're looking at options for a smaller credit line, likely in the $3 million to $5 million range.
Okay.
Much less than the $10 million that was talked about in the past. It signals a shift to, running much leaner.
Okay, running lean. Let's talk about the cost cuts that allowed them to narrow that loss despite the revenue collapse. Where did the savings come from already?
A big piece was working capital management, specifically inventory.
Getting it down.
Yep. Inventory dropped from about $44.7 million down to $40.7 million. That freed up $4 million in cash.
And they use that for?
Operations and paying down some short-term debt obligations. Just managing cash flow tightly.
Got it. And looking ahead, post-building sale, what are the big structural cost savings, the ones that hit the P&L immediately?
There are three main ones. First, the big one. Eliminating almost all that bank interest expense. That's huge.
Makes sense. What else?
Second, they can stop the really aggressive discounting. They admit they were basically doing that just to generate cash when they were desperate.
Right, sacrificing margin for immediate cash.
Exactly. And third, a very tangible saving.
Yeah.
Getting out of the outside warehouse space they've been renting.
How much does that save?
About $1 million a year, they said. That's pure bottom line improvement once they consolidate back into their main facility post-sale.
Okay, $1 million is definitely helpful. Now let's swing back to the operational side, the partners. We know the count collapsed. What about energizing the ones who are left? New products usually help.
They do, but the sales force has been starved. No new titles for about 18 months, management confirmed.
18 months, that's a long time in retail, especially direct sales.
It really is. So new products are planned, but cautiously, not immediately. They're waiting until after the debt situation is resolved. The first new titles are expected later in the spring. They don't want to risk ballooning inventory right now.
Okay, so the immediate operational focus isn't product, it's fixing the partner system itself, trying to reverse that 58% drop.
That seems to be the priority. They're shifting IT and marketing resources away from, short-term cash generation tactics towards rebuilding the partner count.
And they have a specific target audience in mind for recruitment.
They do. Very specific.
Oh.
Younger millennials and older Gen Z parents.
Interesting. Why them?
They believe that demographic is open to direct sales, but, and this is the key, they demand much better technology. They have very little patience for clunky systems.
Ah, so the tech might be part of why partners left in the first place.
Management basically admitted the current tech is clunky. That's their word.
So what's the plan on the tech front?
Investment. They need to make the whole experience mobile first. Easy onboarding, easy ordering, managing everything from your phone, frictionless.
Because that younger demographic, if it's not seamless on mobile, they're just gone.
Instantly. Zero patience, as they put it. So that IT upgrade is crucial for attracting and retaining these new partners they're targeting.
So big picture, cost cuts help. Selling the building is essential for survival. But it sounds like management knows that's not enough.
Correct. They explicitly said that returning to revenue growth, driven by getting that partner count back up, is the next big step toward profitability.
Cutting costs alone won't do it. They need to reverse the operational decline.
Absolutely. They need to find a way to not just stop the bleeding of partners, but actually start adding them again, significantly.
Which brings us back to the stock price reaction. If the debt fix is hopefully coming, costs are down. Why the nearly 10% drop post-call? Why the skepticism?
Because I think the market sees that 58% partner drop and gets spooked about the immediacy of the operational crisis. Fixing the balance sheet is great, necessary even, but it doesn't automatically fix the sales engine.
The market needs to see proof of life in the partner numbers.
Tangible proof, exactly, not just promises. And remember, the stock had actually run up quite a bit before the call.
Oh, right. How much?
Over 31% in the preceding month. So some people were clearly betting on the sale going through and maybe a better operational picture.
And the call itself, specifically that partner number, poured cold water on those hopes.
It seems so. The 10% drop suggests that management's confidence in the sale wasn't enough to outweigh the sheer scale of the current operational damage. Growth fears remain high.
Okay, so looking forward, what are the key things investors or anyone following this should watch over the next, say, 1 or 2 quarters? The catalysts.
Number one, without a doubt, confirmation that the Hilti Complex sale actually closes. Mid-November is the target. That's the big one.
If that happens, it's a major de-risking event.
Absolutely. Number two,
Yeah.
holiday season performance. That's their fiscal Q3. How does sell-through look, and critically, do they stop losing partners? Maybe even add a few.
See if the bleeding stops.
Exactly. And number three, updates on that new IT rollout. Is it working? Are they seeing better engagement or conversion from the partners they have, or recruit? Metrics matter there.
Got it. Anything else? Like the dividend? They used to pay one.
Good point. They mentioned it. Reinstating the dividend is a goal eventually once things are stable, but they specifically warned people not to expect it anytime soon, maybe quarter or two at least was the phrase. Priorities are elsewhere right now.
Makes sense. Get the house in order first.
Definitely.
All right, now for our favorite segment. This is not financial advice, where we cook up an outrageous but plausible trade idea based only on what we heard in the call.
Okay, let's set the stage. The market reaction, that 10% drop, tells you there's significant skepticism baked in right now. Skepticism about the debt fix actually happening and about the operational turnaround. The price reflects survival risk.
Right, so the market is discounting the shares heavily because of that default notice and the partner collapse.
Precisely. It doesn't seem to fully believe management's very high degree of confidence in the building sale.
So the outrageous but plausible trade is basically to call the market's bluff.
Kind of. The idea would be, go long EDUC shares right now.
Okay.
The thesis is pure execution risk arbitrage. You're betting entirely on management being right about the Hilti sale closing by mid-November.
So you ignore the terrible partner numbers for this trade?
For the purpose of this specific trade, yes. It's a short-term bet on a binary event. If that $32.2 million sale closes.
Poof. The bank debt disappears. The default notice is gone.
Exactly. The entire narrative shifts overnight. You go from, are they going to survive the bank, to, okay, they survived, now can they execute the turnaround? The existential threat is removed.
Plus, you get those immediate cost saves hitting the P&L, the interest expense drops off, and that $1 million annual warehouse cost goes away.
Right. Those are near guaranteed financial benefits if the sale closes. The outrageous part is that you're making this bet while staring down a 58% collapse in the core sales driver.
You're betting the balance sheet fix is so significant it temporarily overshadows the operational disaster, trusting management's confidence over the market's fear.
That's the high wire act of the trade. A pure bet on the real estate closing within weeks.
Okay, definitely fits the outrageous but plausible view. So, wrapping up our deep dive on EDUC's Q2.
We saw a company facing a really severe operational crisis.
Yeah.
That partner number, 58% down, is just brutal.
But they have a clear, if high stakes, plan for financial triage. Sell the building, pay the debt, all eyes on mid-November.
It all hinges on that sale. If it happens, they buy themselves time and breathing room. If it doesn't, well, the bank holds all the cards.
So my final provocative thought for you, the listener, building on all this. Management has pinned its future growth on attracting younger millennials and older Gen Z.
Right. The tech-savvy but impatient generation.
They admit their current tech is clunky. So the question is, how quickly can a company, especially one in the challenging direct sales space and just emerging from a financial crisis, realistically overhaul its entire tech stack to meet the mobile-first, seamless demands of that specific demographic?
Can they build it fast enough and make it good enough to overcome the inertia and maybe the negative perception left by the clunky system? That technology gap and closing it might be the single biggest hurdle between survival and actual growth.
Something definitely worth watching closely. That's our deep dive on EDUC. Hope this breakdown helps you understand the moving parts behind those earnings headlines.
Until next time.